Hi, this time we are studying futures. So what do you mean by a future agreement? Future contract is a standardized forward contract agreement. It is an agreement between a buyer and a seller whereby the seller is obligated to deliver a specified asset to the buyer on a specified date, and the buyer is obligated to pay the seller the predetermined price on the underlying asset in exchange of the delivery of the asset. So you must have seen in my earlier video lesson regarding forward contract. Forward contract also exactly the same. The only difference is the future contract is more standardized version of forward contract agreement, because forward contract is mostly OTC product, over the counter. However, future contract should be exchange traded. So future contracts serve as an effective hedging tool to various investors and business units. An investor can protect his portfolio against price fluctuation by entering into a future contract with reference to the index. One can enter into future contracts with reference to a specific stock also. So who are the parties to a future contract? Like forward contract, in future contracts also two parties, buyer and seller. Buyer is taking the long positions. So buyer assumes long position, meaning buy position, and agrees to buy the underlying asset on a certain specified future date for a certain specified price. And seller, other party to a future contract, assumes a short position, which is sell position, and agrees to sell the asset on the same date for the same price. Same price meaning what is predetermined already. The same price buyer is buying that underlying asset, and at the same predetermined price seller is selling that underlying asset to the buyer. So what is payoff? Payoff means the gain or loss to the parties to the forward contract or future contract. It's same. The difference between the contracted price and the spot price. Spot price, the price prevailing on the enforcing or the exercise date. So to a future buyer, if market price is more than the contracted price, then buyer's payoff would be positive, meaning buyer will gain. How much he will gain? Market price minus exercise price or contracted price. Why he will gain? Because as per predetermined price, contract price is lower than the market price. Had the buyer not gone into the future contract, then he would have to buy at the market price. But just because he has gone into future contract and where the contracted price is less than the market price on the date of exercising the contract, so the buyer gains. So what is the amount of the gain? Market price minus exercise price. So if the buyer gains, equal loss has to be incurred by the seller, because seller is selling the underlying asset at predetermined contracted rate, which is less than the market price. So seller's loss would be, payoff would be negative, and that would be exercise price minus market price. The same situation will be just the other way around if the market price is less than the contracted price. In that case, buyer would incur loss, seller will gain. So like forward contract, future contract also is a zero-sum game. One party's profit would be equivalent loss. So both put together it will be 0. Some points we need to remember for futures contracts. Period. Future contracts are traded based on their expiry date. Normally in India, these contracts expiring on the last Thursday of a month. We follow calendar month. Trading, future contracts are traded in stock exchanges. Unlike forward contract. All future contracts are traded in stock exchanges and therefore these contracts are more standardized and more transparent. Regarding size, the contract size also is standardized. The number of units that can be traded is fixed by the stock exchange. Margins. The party to a futures contract is required to make an initial margin payment to the clearing house. At the end of every day, the gain or loss in the futures contract is required to be settled through mark-to-margin account, and this margin is getting settled on a daily basis. Settlement. Settlement is done on the expiry date by way of physical delivery or cash settlement or of offset prior to the expiration date. See, unlike forward contract, which will be effected only on the date of expiry, future contract, because it is getting settled on a daily basis, we can offset prior to the expiration date. I will discuss through illustration in my next video lessons that how offsetting can happen before expiration date, or on the expiry date we can do the settlement through cash settlement or by way of physical delivery. I want to buy the underlying assets, so they will deliver. Yeah. So final settlement price. Future contracts are finally settled on the spot price prevailing on the expiry date after adjusting for the gain or loss reflected in the daily margin account. So what does it mean? It means future contracts are always settled at the closing spot price. So price in the future market and in the spot market will converge on the expiry date of a future contract. We will understand these things better through an example. Before going into that example, let's see what are the differences between forward contract and future contract. Forward contracts are private bilateral contracts. It is between you and me. In gentleman's agreement, we are getting into the forward contract. Whereas futures contracts are standardized, traceable contract and traded on an exchange. In case of forward contract, price is not publicly disclosed. It is determined by the two parties. Yeah. In case of future, it is transparent because it is traded in exchange and you can see the future price. Forward contracts are traded individually and no question of size over there because it is depends on that convenience of the two parties. Future contracts have specified size and value. Forward contracts, because it is private and bilateral contracts, it is mostly over-the-counter product, whereas future contracts, as I said, it is traded in organized stock exchange and with a designated physical location. And regarding settlement, for forward contract, settlement takes place at the end of the contract. You cannot settle before that date. You can, but normally there would be legal implication if you want to settle. Normally it is to be settled at the end of the contract. However, in case of future contract, gain or loss settled on a daily basis. And in case of forward contract, initial margins are not required, whereas in case of future contract, every participant should maintain margin which is decided by the stock exchange. Yeah. So what are the advantages of future market? It is very low cost transactions. You can create future contract at a very low cost. Low cost meaning the cost involved is very insignificant when compared to the value of the underlying assets. Pricing of the future contracts incorporates a set of information based on which producers and consumers can get a fair amount of idea of demand and supply equation of the commodity and consequently the future spot price. Yeah. And future contract, it's a very effective hedging tool for investors and for business houses. There would be very lower risk of default. Future contracts are exchange traded, which require margin payments. Settlements happening on a daily basis, and loss and gain are ascertained also on a daily basis. So therefore, there is a greater degree of control, and the parties to the contract are protected against the risk of counterparty default. Counterparty default risk is very high in case of forward contract, which is not there in future contract. And leverage, which is one of the main consideration to get into future derivative product. Initial amount invested in a future contract is low compared to investment in stocks at cash market. Suppose margin amount is 15%. So, for a stock of rupees 1000, investor needs to invest only 150 rupees. So, with rupees 1000, one can invest only in one share in cash market, whereas in future contract, with the same 1000, one can trade at least 6 shares because I need to pay only 150 rupees, which is the initial margin. So with the same amount of money, I can trade 6 shares for the same cash outgo. Yeah, in this example, but it varies. Margins could be sometimes 20% and defined by exchange authorities. Yeah, so these are the main advantages of future markets. It's in West, it is very popular. In India also, it is gaining a lot of traction for, especially its effective tool for hedging. So now let's understand how daily settlement happens and how the cash flows. On 22nd December 2016, Srila enters into a December 2016 futures contract for buying 1000 shares of TCS at 2500. An initial margin is required at 20% of the contract size. So in this case, margin requirement is 20% of contract size. So how big the size of the contract? Future contract for buying 1000 shares of TCS, meaning one TCS share is 2500. So 1000 shares, 25 lakh. Yeah. On 25 lakh, margin needs to pay 20%. So that is coming 5 lakh. So initial margin for Srila would be 5 lakh. And these are the dates where closing price for December 2016 future price are given. So different date 22nd, 23rd, 24th, 25th maybe weekends, Saturday, Sunday. So 26th Monday, 27th Tuesday, 28th Wednesday, 29th Thursday, and which is the last Thursday would be normally expiry, future expiry date, right? So those days future price are given, what is quoted in the stock exchange, and imagine spot price, meaning price in the cash market was quoting on those days like that. So how we will calculate, normally in case of future contracts, how the daily settlement happens, that is what we will see now. Yeah. So these are the dates, same closing price. So we need to see daily settlement of gain or loss in futures contract in this case. So date, previous closing price, yeah, closing futures price, then gain or loss per share per day. Okay, per share per day. Then total gain or loss, then receive or pay at the end of the day. Settlement is happening daily basis in case of future contract. So now 22nd December 2016. Okay, contracted buy price, how much? 2500. So everything is in rupees here, 2500. Closing future price, as you can see, this is the closing future price. How much is that price? 2550. Yeah, 2550 is a closing future price on 22nd December. However, gone into that contract at 2500, which is nothing but the previous closing price or contracted buy price, right? So what is the gain? Definitely there is a gain because future price is more than the contracted price or previous closing price, right? So gain is this closing future price minus closing previous day's price. So this much gain per share on that day. Which day? 22nd December. How many shares have bought? 1000 shares. 1000 shares. So what would be total gain? This 50 rupees per share into 1000 shares. So 50,000 will be gaining. My initial margin, I have calculated, which is 5 lakh. Already in my account 5 lakh is there. Now I have gained on 22nd December 50,000. So I am receiving 50,000, which is gaining. So balance should be 5 lakh 50. So I am not going into cumulative balance. I am just showing how day to day basis settlement is happening. Now the next day. Yeah, next day is 2550. That is the previous closing price. Because 2550 was closing for 22nd. So for 23rd it would be like that. Yeah. And 23rd closing price 2650. So again, current day's closing is higher than previous day's closing. So profit 100 rupees gain per share on 23rd December. So how much is the total gain? This into, because my future contract for 1000 shares. So on 23rd, I will receive how much? 1 lakh. Clear? Let's go to next day, 26th December. That day closing future price is 2500, which is here, right? And previous day closing, nothing but 2650. 2650. So current day meaning we are on 26th December, and this day's closing is 2500. Previous day closing is 2650. So loss. Am I right? This is loss. This is loss per share on 26th December. Total contract 1000 shares. So this into 1000 share. Total loss 1,50,000. So I have to pay now rupees 1,50,000. How I will pay? It's automatically will get debited from the account. So that is what it is, more standardized and more transparent. Next day. Next day situation. What is the next day? Previous day closing, definitely 2500. So I can put 2500. And on 27th December, closing is 2500. So my previous day closing and this day closing is same. Is there any profit or loss? No. So this into 1000, 0. So neither receive nor pay. Your account, there would be no debit or no credit. Next day. Next day, my closing future price, how much? 2400. Right? Previous closing future price, 2500. So definitely loss. Excel is very intelligent. It's picked up the formula. So loss per share on 28th December is 100 rupees. So total loss 100 into 1000 shares, 1 lakh. So pay rupees 1 lakh. 29th December, the expiry date. If you remember, while we are studying this lesson, I had told that future contract always settled at the closing spot price. See, all these days we are going by future price. Now this is the expiry date, and on that date it converges both future price and spot price. Yeah. So now what has happened? Closing future price, or you can say closing spot price, 2350. Previous day's closing price 2400. Loss 50 shares, 50 rupees per share on 29th. So total loss 50 rupees into 1000 share minus 50,000, or loss 50,000. So pay rupees 50,000. So as you can see, Let me do a little bit cosmetic changes so it will look better and you will get interest in study. As you can see, future contracts are settled on a daily basis, and we can get to know at the end of expiry, when the contract is expiry, how much we can gain or loss. Here, like you can see, we have gained loss. Cumulative loss is 1,50,000. This is meaningless. I can do this. Cumulative loss is 1,50,000. Yeah. So in this case, in future contract, when it is expired, we realize that there is a loss 1,50,000. However, we everyday basis, money came and money go based on profit or loss based on the closing future price and the previous day's price. Yeah. So what would be the payment for Srila? So that's what she did. Buy 1,000 shares. Buy 1,000 shares. Now at the expiry, she is a buyer and having long position. So she has to buy the shares at rupees 2350 now. So buy shares at rupees 2350. That is nothing but the closing price in cash market. So how much she has to pay? 1,000 shares into 2350. So she has to buy 1,000 shares because she was having long position and she has to pay 23,50,000. Okay, not only that, already she incurred loss this. So in other words, she has to pay 1,50,000 also. Understand, this loss has been debited from your account. She does not need to pay separately. It's already been paid. But in effect, she paid that money. So I am keeping that with. I am trying to calculate how much cash outgo has happened. Yeah. So this is loss and share value she paid. At the same time, once the contract is closed, exchange will refund you your initial margin unless you are not getting into again future contract. So this time you will get the refund of initial margin. How much? You paid 20% of the contract value. What is that contract value? The price at which you entered into the contract, which is 2,500 rupees per share. 1,000 share. So total contract value 25 lakhs. On that 20% initial margin in this example, which means 5 lakh. So 5 lakh, now at the expiry of the contract, exchange will refund. So net, she needs to pay 20 lakhs. Am I clear? So that's the cash outgo. Yeah. So this is the way future trading has happened and settlement happens on a daily basis. So once again I am telling that future contracts always settle, that means at the closing spot price. So price in the future market and in the spot market will converge on the expiry date of any future contract. So here for December future contract, the future price on different dates up to 28th varying significantly from the day's closing price in the spot market and future market. However, on the expiry date, future price for December futures and closing spot price will be same, if not same, almost equal. There might be very minimal decimal differences could be there, but by and large it is same. So that on that date, why it is same? It is eliminating any arbitrage opportunities on that closing day. We will study arbitrage later. So in my next video, we will try to see what is index future. Thank you.